Hello, everybody, and welcome to the monthly market memo for the review of May and the outlook for June 2026. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk you through some of the key themes that shaped our markets for the month of May and for most of this year, and get into a little bit of the outlook for the rest of the year and the summer to come. So without further delay, let's go ahead and jump into it. I'll start with just a quick agenda, and we'll talk through some of the slides we'll be going through here. Um, Markets definitely continued their hot run in May. The last 2 months or so, the last 8 weeks have really been astonishingly good returns for equity investors. And most of those returns, if not all of them, have been driven by very, very strong corporate earnings, which is the main reason why we invest in public stock markets to begin with. So that is a very welcoming sign. I'll get into that. And we'll talk a little bit about what this leaves us as the road ahead for the Federal Reserve. We like to look at this very closely as will they be cutting interest rates or hiking interest rates? That is something to be determined for the rest of this year. It's really shifted, and I think you'll find that interesting. And then finally, this summer will mark the largest IPO ever, and obviously here in the United States, which is SpaceX. So we'll walk through some of the key considerations there for that big market listing to come here in June, we believe. So let's go ahead and jump into just the returns for May themselves. Really good month. If you remember, April finished about up 10% just in that month of April for every major equity market we track. May was very much a continuation. We saw basically close to 5% for the major equity markets in for all of them. S&P 500 led the way up 5.25%. International stocks up over five, mids and small cap stocks up close to 4.5. Bonds positive, cash positive, obviously. So just a really good month of May. Continued the great month of April. As I mentioned, we've had a great run here for the last couple months. Um, Most stock markets are actually up double digits already for this year, which is amazing. Just draw that line across the 10%. You see the S&P 500 is the laggard, if you will, but it's still up 11%. International stocks up 14 and small and mid cap stocks kind of the surprise up over 18%. And we're not even halfway done through the year. So we'll see if we continue to add on to those gains. We think there are some bullish outlooks for the market that can definitely continue these gains. We'll have to see. Bonds can still provide it, bonds and cash can still provide that ballast for you if you're not needing or wanting or can't take on all the risk of the stock market. They still provide really good income. Both of them do, actually. So, really good returns for May. And it was one of the best 8 weeks. So I looked at this, 8 weeks, let's just call it maybe 2 months roughly. The S&P 500 saw really, really strong returns. In fact, from what I looked at, we were in the top 1% of all data going back to 1988. What that means is obviously most of the time you don't get 18% returns in 2 months. So it was just an astonishingly good month of returns, good 2 months of returns here. Kind of a wonky chart, but what I'm trying to show here is where most months really land. Kind of, it's a typical bell curve. And where we fit is that dotted line there on the far right. So plus 18%. Obviously, there were some numbers in weeks that were a little bit better than that, but still really, really strong returns. Seldomly happens. I wouldn't expect a pullback necessarily. Sentiment's still very much negative across, so we don't believe there's a big pullback coming. But temper, expectations for the next 2 months. I don't expect to see another 18%. But stranger things have happened in the market. Typically, you see about 2% returns over those 2 month time frames. Again, we were up over 18%, and that is strongly within the top 1% of all rolling data back to 1988 from where I found this. So just an amazing start to this end of spring, start to the summer, and the bull market is definitely alive and well here in the United States and globally, really. So what has led to this? What has really boosted the markets here? And it is earnings growth from our biggest companies and small companies as well, and overseas has been pretty good. So this is really the reason why you invest in stocks to participate in those earnings from these companies. We looked at this a lot of different ways just to see how good it was. The breadth the magnitude and just the all-in growth rate has been way better than expectations and has pushed this market to new highs almost day after day. I think we've seen about 20 or so new highs already this year. So what I'm talking about here is breadth first and foremost. The number or the percentage of companies that typically beat the analyst expectations, the Wall Street analyst expectations, is around 75 to 80%. You can see that in the top two bar charts there, 10-year average, 5-year average. We are at 84% right now. Again, 84% of companies are beating analyst expectations. Very good, very good. Now let's look at the magnitude. Typically, how big are their beats? If they do beat, by how much is it? Now the 10 and 5-year average again is around 7%. We are double that at 16, going on 17% of magnitude of beats. So just when you're beating the expectations, you're beating it by a large amount, which has led to big upward swings in a lot of these markets. And then just the year-over-year earnings growth has been phenomenal. The average again around 8 to 9% in the last 10 years. Coming into this quarter, we were expecting analysts, if you will, were expecting 13% growth. Still very good. What do we get? We're probably sitting at around 28% or so, and most of the companies have already reported. So just really good returns. Of course, we participate with that as being equity investors, and that has led to the stock market moving higher. However, the interesting thing I think we get questions on is, does this mean we're in some sort of bubble? Whenever you see quick gains in the market, people get a little bit leery, fast money, if you will. But from what we just mentioned and what I can quantify here is that earnings are driving this market, not just bullish price action or putting a lot of money into companies that don't earn anything, right? And just hoping. Um, these are well-founded companies. They're delivering earnings. Their prices are reflecting that. Now, they've actually pushed valuations down. Let's just say a price to earnings ratio, which is a very common way to look at how cheap or how expensive your company is according to the market. So the S&P 500 up about 10% this year, as we mentioned, through a couple of days to the end of the month. That's what it was. Earnings expectations for the next 12 months for forward earnings expectations is up 15%. So even better than what the stock market's done, which means the actual PE is a little bit negative. So I think we still can have more room to run if we get more exuberance in the stock market, people putting more money to work, you can actually see that price get a little bit higher and continue this bull market. So far it's been a foundation of earnings growth, which is always a good thing. It'd be a little bit of a worrisome thing if it was just driven by price, price returns at any price, basically. If you're just buying companies with no earnings, that would be a little bit of a worry. But a lot of these companies have really good earnings, so good things there. Now let's look ahead. Oil and gas prices, we believe, will stay elevated. The war in Iran and the conflict there just continues. Negotiations are good, then they're bad, so it's going to be volatile. Just expect that. As of late, inflation has moved higher, which has challenged the Federal Reserve's next move. We really started the year expecting about 2 to 3 interest rate cuts, but now the market is almost expecting an interest rate hike. So I want to paint that picture for you. We're looking at this across a couple different ways to handicap it. We look at futures contracts on the federal funds rate. We look at betting markets that are very deep and prevalent right now. And you can just see that over time, it's been pretty low, maybe 10% in this market, and then almost 0% at points in the Fed fund futures. But the average has been roughly a 40 to 50% chance of a hike here before the end of the year. And then 2027 is more of the same story. So not necessarily a good thing. Stocks don't really respond well to hikes. They respond to cuts a little bit better. So interest rate hikes to get inflation under control, not necessarily a great thing. However, I think the question is, are we actually going to see an interest rate hike? I think it's going to be a little bit more nuanced, and I really don't think so. When you look back at history, when the Fed does look to raise interest rates, they see a major problem ahead on inflation, and they see a jobs market that would be very solid. I think really the second part is not necessarily true. The jobs market is improving, but it's not great. And then historically, a hiking cycle consists of numerous hikes, not just a one and done, and let's see what happens. It's going to typically be a hike and a hike and a hike and so on and so forth. And really, when I look back at the data, we only saw about two times in the modern Fed era that they actually hiked less than six times. So do we really think the Fed is going to hike at least six or seven times? I don't think so. I think the markets are predicting a hike, but it doesn't necessarily mean it's going to happen. So just look at throughout history again, the average is about eight hikes on a hiking cycle. You did see a couple instances, 87, 97. 87 was more of the flash crash, afraid of a recession, so let's not hike anymore. 97 was probably your true one and done insurance hike episode, which some people are saying we're similar now. We're similar to the late 90s of as far as bullish stock markets. So I don't think one hike would derail us, but I definitely don't think that a hike is a for sure thing at this point. One of the last reasons I would say that is we do have a new Federal Reserve Chairman, Kevin Warsh. He wants to look to move their preferred inflation measure. There's a lot of different ways to look at inflation, CPI, PCE. He likes to look at trimmed mean, which basically just means let's exclude all the outliers, a couple of the big outliers, and just look at that core inflation compared to what we have now. And consequently, this would paint a better picture to where we're at. Obviously, the Fed target is right around 2%. That's what they say it is. PCE inflation has been rising. It's right around 3.3%. That's what I'm showing here. What Kevin wants to look at, Mr. Warsh, Chair Warsh wants to look at is a trimmed mean PCE, which was right around 2.4 last time I looked. And again, the Fed target is around 2. So, that would basically say no need to rush into rate hikes at this point. For better or for worse, this is going to be their decision. And, I think a Federal Reserve on hold, not cutting, not raising rates, is probably what we'll see for the rest of this year, unless something really changes, either a big spike in inflation again, or a severe jobless market or a recession potentially. But none of those are base cases, so I think it's more of just wait and see where we're at. And then finally, thanks for your attention so far, SpaceX. I think this is something we get a lot of questions on. It's going to be the largest IPO initial public offering ever in existence. So it has been a private company. They're going to list on the NASDAQ stock market, and they're going to try to go here in June 12th, is roughly the IPO date. When they do, they're seeking about a $2 trillion valuation, again, the largest in history. That is mega, mega large. However, this IPO, a lot of questions are, can we get in on this? Can clients get in on this? It's already expected to be very, very oversubscribed, as you could guess. Therefore, it's going to be very hard to get shares. Typically, most custodians have a minimum of 500,000 or so to even try to put yourself on the list to get it. So it does seem very hard to get those initial public offering shares. Once the stock does go public, of course, you can go in and trade it and buy it. But most of the returns typically in IPOs happen on that first day, which is very hard to get. However, we would say that a lot of funds that track the NASDAQ and track other indices will include SpaceX very quickly, meaning if you own some of these funds, which maybe we do, you may see SpaceX as one of the holdings in there. It's not going to be a big allocation, maybe 1% is what I've been hearing, but it will be in those funds. A $2 trillion market cap, to put that in comparison, that is bigger than Berkshire Hathaway. It is larger than Meta, and it's larger than Elon Musk's other company, Tesla. So it puts it in the top 10 for sure of largest companies. But to really show that value, we need to see more shares come to the market. Otherwise, it's going to be a small weight in the overall market to begin with. Again, expect volatility. Obviously, with a market cap of this size and an expectation of this size, we expect to see a lot of volatility. We expect to see a lot of insiders trading their stocks and selling their stocks down, pushing the market down. But there's a lot of demand out there to pick up that demand. So regardless, still volatile in the marketplace. At the beginning of June, you can look to contact your advisor and your custodian to submit a letter of intent to maybe subscribe to it. 11th and 12th, we'll officially know what it's pricing at. And then, maybe some better opportunities will become later this year as some of those selling pressures ease. But a lot of these lockups will end at the end of this year in the fall and at the end of and beginning of 2027, where insiders can sell more of their shares to the market. So SpaceX is a big one. Anthropic is a big one. OpenAI is a big one. These are all AI related stocks at the end of this year that we are expecting as well. So again, call us with any questions. Thank you for watching the video. And we approach the management of your complete financial landscape very seriously as a trusted steward, advocate, and confidant. We are completely committed to you, the client. Reach out to us with any questions. Again, I hope you're having a great summer. It's been a good year for the stock markets, and we will talk to you in about a month's time. Thank you.